Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 29. As always, joined by the three amigos, or as Keith likes to say, the three hosers. We've got Rich Diaz with Acorn Macro Consulting, and we've got Keith Dicker with IceCap Asset Management in the sexy black shirt. Welcome back, gentlemen. To get into this week's show here, again, the Loonie Hour live event in Vancouver, May 12th. We're about half sold out right now, so tickets are moving fast. We will probably be sold out here, I'm going to guess, in the next few days. So head over to our Eventbrite page. There's going to be a link. If you're listening on Spotify or Apple Podcasts, whatever, there'll be a link in the description where you can go directly to purchase tickets. They're $30. And same thing if you're watching this on YouTube. Again, check the link in the description below to go get your tickets. So looking forward to that. It's going to be a great event. We'll do the live podcast. We'll do a Q&A after. There's going to be beers and booze flowing, free sliders. Keith's going to be, devouring them all. But there should be some left for everybody. We're still undecided on the Velcro suit. We're going to see if we can line that up. There's been hot demand for that. But anyways, like I said, May 12th in Vancouver. We'd love to see you. We continue to build this community here. And all we ask that you share the podcast as well with one friend or family member. But let's dive into this week's show, gentlemen. Maybe a little bit update here from, let's say, the Bank of Canada, expected to go another 50 basis points. Some comments from our favorite governor, Tiff Macklem, who says, I will not rule out increasing interest rates more than 50 basis points, but it would be very unusual. Of course, he's referencing the upcoming June meeting, but it seems all but sure that we will get 50 basis points again in June, which, as we've talked about in the show, all you have to do is look at, well, the BOC has raised rates by 75 basis points and housing has already hit a brick wall. We're still running real negative interest rates of about 6%, negative 6%. So again, financial repression. If you're looking for your opening line to swoon any females, financial repression, as Rich has advocated for. But I wanted to touch quickly on what's kind of happening here locally in Vancouver. We're getting a lot of anecdotal stories, and I've actually haven't heard this. Like there was a bit of a bear market here in 2017-18, and people like a couple of lawyers we've been sort of in communication with have been reporting buyers trying to back out and renege out of firm contracts. So basically, they're saying, "Hey, lawyer, I want to back out of my contract. I'm willing to walk away from my deposit." And the lawyers are going, no, you can't just back out and lose a deposit. Like you could blow up 3 deals here because they're all kind of connected to each other and you're going to get sued for damages. So having several lawyers coming out and saying, hey, we're getting an unusual amount of calls, 2-3 phone calls a day of people backing out of contracts. Again, is very fascinating when we really consider that rates are only up. The overnight rate in Canada, of course, is at 1%. The Fed, who hasn't even really started the rate hiking cycle, I mean, they've raised 25 basis points. They're supposed to go, 50 basis points in May? Is that right? Yeah, 50 basis points in May. And to maybe add to some confusion, Rich, will get you to unpack, is US GDP in Q1 negative. So, Rich, I mean, there's some nuances behind this. So maybe just give our listeners a little bit of background, and then maybe we'll jump to Keith for maybe his financial commentary on what does a negative GDP print potentially do to the Fed?
Okay. So, I mean, we've talked about this a little bit before in the past, is that you have to be careful when you're out of such a severe dislocation. You have the reverberation of the data and when, in many ways, we're still in the coronavirus virus pandemic. Maybe not necessarily sort of in lockdown or, the obsession over vaccinating people or et cetera, but we are definitely still in the midst of it with respect to the economic consequences of those political and economic decisions. Supply chains, for example, would be a quick and easy way of an example of that. So when you're looking at these GDP numbers, I think it's important to just keep that in mind. But anyways, let's just get right to it. So it's with negative 1.4 is the number. These are seasonally adjusted annual rates for people who are inclined for that, who need that kind of detail. I actually think that, yes, so obviously negative worse than is obviously bad, and positives are generally good. But I think there's a couple of takeaways that I thought were actually really good. I'm an optimist, and I have a constructive view on growth, so forgive my bias, but I think it's important. Number one, I think that a lot of the negatives was due to the imports. So imports were up 17%, 17.7%. That's incredible. And so if you look at GDP, I'm not going to get into, this is not a teach-in, but GDP equals basically consumption plus government spending plus investment, and then minus net exports. Plus net exports. And in the US, net exports are negatives. They have a huge, deeply negative current account balance, and negative trade balance, And so how much you import and how much you export affects your GDP. If you import a lot and you don't export a lot, your GDP goes down. And so that's one of the bigger contributing factors to this quarter's GDP, and why it's negative. But on the positive end, so why I think that's positive, actually, sorry if I rewind, is because imports mean you have strong consumption. So it's contradictory. It's kind of weird, but if you pull yourself away, an economy that's actually importing lots of goods is actually doing relatively well because people are consuming. And if you're weak on the export, it might be a reflection of, outside of your economy not doing so hot. Yeah.
How much of that is retailers like restocking like warehouses and, beating down supply chains? Like, I'm always thinking like, okay, if I'm like a furniture store that, it takes 8 months to get a couch, and historically over the last year and a half, maybe I start ordering a lot more couches and just throwing them in my warehouse.
Yes, that's definitely part of it. I think that's definitely part of it, but it's also, it's not the whole story. We know that goods, for example, there's also, that is its own line item. The release I'm looking at right now, for some reason, doesn't actually have that number, but which is kind of not good. But there's a lot of imports of goods and services, which is also, that's the trick. You don't need to necessarily restock services. Services were up 3.8%. Oh, sorry. We're up, 4%. Sorry. And goods, there was a huge amount of goods that were imported, and in general, that is part of it. There's inventories are still very, very low, and they're improving.
So what would be your like overall summary if you could like dumb this down to sort of just a typical listener say, okay, well, give me the Coles notes. Like, are you bullish or bearish after this print? Like, is there any takeaway, or is it just like fade the number completely and just ignore it?
No, I think that there's 3 positive takeaways and 1 negative. 3 positives are imports are going up. That's a good thing, even though it's bad for GDP growth. 2 is the gross fixed capital formation, which is another way of saying investment, or CapEx, is also positive and okay, along with services. And the other thing is there was a big negative from government consumption. So federal spending on, for example, defense and other non-defense items was negative, and that dragged down GDP. So on the whole, like, yes, I get the number. I preface it all by saying that the volatility, you got to be careful when we're still in this mess. And so it's not, we're not in a normal cycle. And so you have to be careful about of spending too much time judging these numbers. But in general, I think it was actually okay. But, I'm a glass half full kind of guy. So I don't know, maybe Keith can pour some water on my optimism.
Yeah, Keith, I don't know, do you have any takeaways? I mean, again, particularly maybe from like a financial market perspective of, does the Fed even look at this and go, okay? Or is it just like, nope, status quo, 50 beeps? And, I'm curious, I don't know if rate hike expectations from the market have changed at all, or just completely unchanged and fade the number.
Yeah, so just a couple of things. The first thing, this will not change what the Fed is going to do. So the Fed, they'll continue on this path. Rich, I love the optimism. That's fantastic. I'm a realist. Okay, so let's look at it from that kind of perspective, which I know Steve likes as well. Okay, so I think like the difference with the view that I'll share with you now, what Rich just viewed with you. Rich is sharing the view from a U.S. centric view, and everything he said is correct. The view that I'm taking on it is from a global perspective. And there are a lot of check marks from this data point, which again, I think I mentioned before, like as an investment manager, you wake up every morning or the afternoon for some guys, I guess, but you want to see what's happening in the world. And is there anything that's happening that's either going to cause you to adjust your view or change your view, or is there something happen that really further reaffirms your view? So today for us, this is a big day in the market. Like this is just outstanding. So we'll go into the first one with the GDP print. So our view for a while now that we've shared is that, with the Americans raising rates, this is going to suck capital out from the rest of the world. And my concern has been that the EM world and Europe, everyone else, they're going to start slowing and all that stuff. And so when I see, net exports for the US, it's fall. The Americans are importing more, but they're exporting less. I see the exporting less function to mean that the rest of the world is consuming less. So this confirms my view that the global economy is slowing. And I don't get too, caught up in, the headline number was negative, of course, which was an initial shock. But again, we're headed for a slower economic environment coming up. The other one that we've talked about before is that, government spending, fiscal stimulus is going to be declining. And that showed up in this report as well. So this report for us here at IceCap is just telling us, hey, this is the path we're going down. It hasn't changed. Nothing from this report has changed. Whether next quarter will be another negative print, I don't know. I don't know the number that well. Don't be surprised if it's another positive. Sorry, if it's a positive print and not negative. But the other thing, from the Fed's perspective, they're looking at this for saying, hey, this is stagflation right now. We have inflation, growth is slowing, and that's a pretty tough cocktail coming up. So that's the initial thought from my side. I know, Rich, you were.
Well, there's just one tiny thing that I think it's important to add, which you touched on slightly, which was that these numbers get revised a lot. I mean, GDP is a backward-looking indicator. So as far as the market's concerned, I think a lot of this may or may not have been priced in. I think anybody who's really obsessed about GDP probably has their own models and has their own view on it. That's the first thing. And second thing, a lot of these numbers get revised. And so it's important to just it's important to sort of acknowledge it and do exactly what Keith said, which is to confirm or deny your previous outlook or your view. But it's also, you can't take too much stock in it. GDP is really, really hard to calculate for an economy with 330 million people. It's often revised significantly. And so you have to just, take it for what it is, which is just another sort of crumb on the road.
Rich, I think you've somewhat updated your views as well, which we'll probably get into here shortly. But to me, I mean, it feels like there's a lot of stuff happening, under the surface, which is, I think, was the Bank of Japan was out again. I know we've talked about this the last couple episodes, but they were out again saying now it's like unlimited bond buying in order to sort of maintain their yield peg. And meanwhile, what is their currency against the US dollar is now at 20-year low. The finance minister was out. I don't know, it was today or yesterday saying that they were going to respond, quote, appropriately to abrupt the moves after the currency plunged. So, yeah, I mean, and then you've got, so they're trying to maintain their peg. Like, I'm trying to sort of keep this simple here, but they're trying to maintain their peg. Meanwhile, the US dollar is going to start, or sorry, they're not trying to maintain their peg, but they're trying to maintain their yield curve control. That's what I meant. And the Fed is going to start raising rates, but probably about 50 basis points next month, which we've talked about sucking capital into strengthening the US dollar, so weakening the yen even further. Like something's like just feels like something is going to break here. So Keith, I don't know if you have any updated views on what's happening with the Japanese yen, because basically a lot of these central bankers are kind of screwed, and they're like, basically looking at the Fed and going, oh shit, please don't raise rates. But the Fed's like, well, we got a domestic inflation problem here and political pressures. So we're gonna do what we need to do.
So this was the other event that caught my attention. Actually, it was the first event. So I get up, this morning early, and my screen is not a lot happening on it, except the yen is down 2%. And if a currency is down 2%, that's enormous, especially when everything else is flat. And so I really want to share this, and I cannot emphasize this enough. As of today, this is the financial market event over the last 10 years. Like, this is incredibly important to understand why it's happening and why it's different. And people say, oh, it's different this time, that doesn't work. That's false. So with Japan, they've been in this 40-year period of deflation. They've been printing money, QEing, deficits, you name it. And people say, well, that's never worked out before. So it's never caused any stress before. Today, we now have this global economy, global monetary policy, and global fiscal policy, wacky geopolitics. Everything is synchronized. And for the first time over the last 40 years, interest rates are starting to rise aggressively in the Western world. So the overnight rates are being, they're increasing because of the Bank of Canada, the Federal Reserve. And also, we talked about last week how bond markets are getting crushed around the world. So that means long-term interest rates are going up. In Japan, they cannot tolerate that. So if rates start going up in Japan, so you get a couple of things that's happening here. First of all, it just completely blows out their government borrowing levels. So deficits start surging because they had to pay 2, 3, 4% more on it. Also, the banks, the pension funds, and the insurance companies, they're stuffed to the gills with Japanese government bonds. So if interest rates move up dramatically, these guys have huge losses on their bond portfolios. And if something breaks, they get something breaking on their regulatory capital, which is even worse. So you have that stress taking place. So the Bank of Japan, because remember, you have the Americans raising rates, the Canadians, everyone else. In Japan, they can't raise rates. It just doesn't work. So you have that pressure taking place from all over the world. So the Bank of Japan, they had a decision to make. Okay, do we want to protect the bond market and let the currency go off sides, or save the currency and let the bond market go off sides? And they're both horrible outcomes, but the least horrible outcome is to save the bond market. So just imagine now you hold a 10-year a Japanese government bond. You know that, you're going to get paid a 1/4 point on it. That's it. So 0.25% is your return on it. You're a foreign investor. You also know you're going to now get hosed on the FX side of it. And you know what? There's a guaranteed buyer right now. And if that guaranteed buyer suddenly says, I'm not going to guarantee the price anymore, the price is just going to plummet. So you're selling. You're getting out of this, right? So you're selling your Japanese government bond. You now have yen in your pocket, and now you're going to sell that yen and buy dollars or Canadian dollars or euro, whatever you want. So that's been happening, like in gobs of this stuff happening, especially over the last 24 hours. On top of that, just say you like this carry trade you might hear about. So I'm thinking now, Rich is a sharp guy. He's going to say, you know what, I'm going to go over and borrow like gazillions of dollars of yen at 0.25%. And I'm going to sell that yen right away and then buy overnight treasuries because I'm going to earn 1% in it. It's a win-win-win. So you have that stuff happening as well. So the point is, now all of a sudden you got this huge shift. The yen is coming off aggressively. Like, there's no bottom in sight here. Like, they'll just let it go until we find a floor. But that's not the best part. I'll let you guys comment further on Japanese, but then I'll go into the other part. But the other part is what people don't realize what's happening as well is with the CNY. So the Chinese currency, that moves lockstep and barrel, I guess, if that's a bad quote. But it moves in line with Japanese yen as well. And CNY is now at its like stressful point as well. And I'll explain why that's happening as well. But you guys want to comment on the whole yen story before we move on?
No, I mean, I'd like to just really add something on top of that, which is like, we talk like it's a Canadian show, but here we are talking about like Japan, right? And like, but this is the whole reason why we started this show, because like I'm literally like, I live on Twitter basically, and part of my day job is just responding to trolls. And, these guys are like, oh, who cares about all these over-levered Canadian households? Like the Bank of Canada is going to keep raising rates, and that's what they need to do. And if a couple households go bankrupt, big deal. And it's like everyone's so focused on like raising rates and like looking at Canadian housing. It's like, no, like I'm looking at like what Keith just said. Like, I'm looking at the Japanese yen. Like I'm looking at, Japan's government debt to GDP is 252%. I mean, like that, how many, like, I'm just thinking here is like how many Canadian households are sitting there and like their equity and like, they're richer than they think. Like I can't think of anyone that's actually thinking, oh yeah, wonder what the Japanese yen's doing today and how that might impact like the asset value of my house, which is like my largest asset. So when we talk about these foreign markets, like just understand that there's always a correlation and that all these financial markets are tied in together. And I think that's really like the biggest thing when we see all these like bank economists coming out with these forecasts, that they're economists. They're looking at like charts and graphs. They're not looking at financial markets. They're not looking at the underlying and how that can all sort of interconnect. But Rich, I'll let you maybe comment further. But I'm just trying to sort of tie in all the correlations for Canadians to sort of keep note of here.
So on the yen, I don't have much to add on the yen. I think Keith's outlined it really extremely well. I think I'll just add a little bit of context, maybe from a data perspective. I mean, the two, Keith was a little bit cavalier in saying, "Oh, it's quite rare to have a 2%." I'll tell you exactly how rare. Since 2015, I think it's happened like 4 or 5 times. So if you think there's 260 odd trading days in a year over a span of 7 years, and this is probably the 4th or 5th, depending on when you started and what your category is. I think one of the occurrences, it was 1.99% down in one day. So let's just throw that into the 2% bucket. This is an extremely, extremely rare day for such an important economy. Remember, Japan is about 10 to 12% of global economy. The Japanese equity market is, 6 to 8% of the global equity market. This is a big deal. We don't,
Their largest economy, no?
Yeah. I mean, yeah, exactly. Yeah. I mean, it's obviously China on a PPP basis. China is the largest economy in the world. Then you got the US, and then you got Japan. So this is when you have, and it's, I think it's, after the US is probably the largest amount of sovereign debt in the world. So when you have that kind of move in such an important currency, it doesn't matter if you're in Corner Brook, eventually, it'll be affecting you somehow. And I think it's really important that we have these discussions. I think Keith's got a much better handle on Japan as an equity market and as a financial. So I'll pass it back to him. But I just think, just to give you an idea, it's only been 3 or 4 times in the last 7 years of trading.
Did you say Corner Brook?
I was trying to think of a random place in Canada that doesn't care about Japan. What do you got against people in Corner Brook? What do you got against people in Corner Brook?
We used to go back when I was at school. We used to go to Marble Mountain for a ski weekend every winter. That was a good time.
That sounds like a fake place.
Who's not thinking about the Japanese yen is Rick from Red Deer.
Yes, that's right.
Okay, here's something to throw out for the Loonie Hour fan that we have. And I'll share why I believe this is going to happen. I think this is now setting the stage for the probability that the Bank of Canada will be cutting rates in 23. That's what we're headed towards. So I'm going to line that up with you and why I think that's going to take place.
You just pissed off a lot of millennials.
Well, that'd be great for them, right? If rates are going to come down.
Oh, man, the millennials want housing to crash. They need to get in.
Oh, okay.
Don't get me wrong. I still think housing's under. Okay, guys. Well, another story. But housing is still under pressure. Don't worry. They'll probably keep raising rates until something breaks, as we've talked about. But I'm in your camp, Keith. I think rate cuts in 23. But let's see. Anyways, continue.
And there's some great ways to play that as well, by the way. Like, it's looking really nice. Okay, so I mentioned plug. I think I mentioned what's happening with China as well. So in China, we've already talked about they actually cut rates a few weeks back. Their currency is pegged to the dollar, or a basket, the dollar plus a few other guys, and their capital account is slow. It's a very different economy in China than anywhere else in the world. So it's hard to go apples to apples with anything. However, we do know that whenever yen experiences pressure, the Chinese currency experiences pressure as well. And the amount of pressure experienced by the yen right now, to say it's to the nth degree, if you want to pull up your charts on the Chinese currency, that's also skyrocketing, but nowhere close to what's happening in Japan right now. And I'll share with you why that's happening, and why remember, we live in my world, we live with probabilities, and it's never a 0% to 100%. You always like sort of move your lever, up and down in between. But the probability of the world experiencing a significant shock right now, which will be a deflationary shock, by the way, it's now gone up dramatically with what's happening in Japan this morning. So in China, they also have the inflation problem. They're not able to raise interest rates, because if they do, they'll just crush their real estate market, basically. They already have stress with their real estate developers. That's happening. The currency is pegged, so they can't use that as a relief valve. A pegged currency, and especially in China, it only works really well with little stress if US dollars are flowing in all the time, right? So if global trade is going well, they got dollars flowing in, they're able to swish it around, maintain the peg. And that's not happening right now. You also have inflation is going up around the world. China imports everything, basically. You think about it. They import all the basic raw materials, and then they'll use it to create whatever else, and then export that. So one view of what's happening in China right now is with the lockdowns they're having from COVID in Shanghai, and I forget the other large city. I don't know. I don't know.
I think Beijing's supposed to be getting locked down next, apparently.
Yeah, it's pretty significant. So it's sort of irrelevant why they've locked down. But by doing that, remember we've talked about how can a central bank reduce inflation? And the Americans and Canadians want to raise rates and all that stuff. And when we've said before here on the show, another way to do it is just to crush your economy. That's how you really bring demand down directly, as opposed to this, loosey-goosey kind of way. So that's what China is doing right now. They're reducing their domestic demand. And you've also noticed commodity prices have now been coming off as well, right? I mean, oil is down from that peak that it had. Everything else is sort of sliding.
The curve. There's the oil curve which has gone up,
yeah.
But we keep going.
But China right now, they're starting to shut this stuff down, and so which is causing this stress on their peg, because there's not enough dollars coming in. Domestic spending isn't happening and whatnot. That's also putting stress on the Hong Kong dollar peg as well. That's really the conduit, and which with HSBC, by the way, that's their bank that they use as well, by the way, to get everything in and out. But you have all this stuff happening, and if for whatever reason one of these pegs break, it's either the Chinese currency or Hong Kong dollar. One leads the other, by the way. Like there's no way one can survive without the other. Then we get this very dramatic deflationary shock around the world. But then you will see the response from that, of course, would be central banks no longer raising rates, and then even cutting rates. So the probability of that scenario happening, so you're looking out into Canada, maybe say 9 to 15 months. That's what a few months ago, the probability of that happening was quite low. It's a non-zero event, but not zero. Now, from our view, all of a sudden it's increasing, it's going up. So right now the market is expecting the Bank of Canada to be at 3% in December of 22. So what's that, 8 months, 7 months away? I don't know. I'm suggesting that the probability of them, if they do get to 3%, that'll be it. That'll be peaking. And then they'll either be flat thereafter or they'll be cutting. But this is one of these moments where what markets are pricing, and then what a very smart narrative will tell you, it could be something very different. And this is a dream, like from an investment manager's perspective. You say, wow, this could be a really cool opportunity. And it all started by seeing what's happening in Japan. So that's a bit of a roundabout way of what's happening.
Did you guys? Okay, Rich, go ahead.
No, go.
I was gonna say, did you see? Was it the Fed funds rate supposed to get to 5%? That's what Deutsche Bank said.
Not happening.
But are these guys
Not
actually
happening.
are these guys actually that dumb, or what? I don't understand.
No, I mean, so I think
like, are they trying to
Go
make
ahead,
money
Rick.
off of that statement or something? Like, come on.
I mean, yeah, I think it's a bit boring for me, from my perspective, because I think Keith and I, my views changed. I'm much, 6 months ago, I was very bullish, and when the data changes, you got to change your view. And the three things that have changed my view, which have really aligned with Keith, and two of them he had no control over, so I would throw them in the Keith's lucky bucket. But one of them, he had spot on. And the two that he had no control over is, I was certain that after the Olympics, that China would back away from their COVID zero policy. And then Keith carefully skated over that. But let's be clear. If China unlocked their economy and got over this obsession with getting rid of COVID, you wouldn't have the backlog of supply of boats in Shanghai Harbor. A lot of the deflationary things that are going on wouldn't be going on. And so that's something I didn't anticipate. And like, I have to incorporate that into my analysis. The other thing that I think we just keep forgetting about is the war in Ukraine, which we haven't discussed in a couple of weeks. But by all measures, I think that that's going to be a much more protracted and much uglier war than certainly Vladimir Putin expected, but the rest of the world. And so even though it's not on the headlines because everybody's worried about, I don't know, the Kim Kardashians or something dumb like that. I mean, it's going to have, if they do not allow oil to be imported into the EU, like, I think Poland's already said that they're not going to do it, not going to import oil. But these are deflationary impulses that I don't think any of us were expecting 3 or 4 months ago. And then the final thing, which I think Keith alluded to, which I think is really important and which is affecting sort of my view on risk assets, is I think that the Fed is going to be stubborn. And this is where I'd love to hear, Steve and Keith's view on, but which is, I think that they're going to raise rates, even though, and this is going to make me sound, contradictory, is that they probably should be realizing that they are the global central bank, and what the world needs right now is actually probably to hit pause on that, and to sort of mitigate China's, intransigence on COVID zero. And I know that those two things can never be, you can't have those things together, but I think that's really important. The other thing, Keith, I wanted to add before we go on is there's something called a policy trilemma, which Keith sort of is alluding to, or some people call it the impossible trinity. And this is why China's monetary and fiscal policy and exchange rate policy is so kind of silly in a way, and it always in effect leads down the same road. And that policy trilemma comes from having you get to pick two of the following three options: free exchange rate, monetary policy autonomy, and free capital mobility. And you get to choose two of those three. So if you fix your exchange rate, you don't get to decide what your interest rates are, and you can have capital flow in and out. Or or like in the US, you choose your interest rate, and you have free capital mobility, but you don't choose what your exchange rate is. Exchange rate goes up and down. And what China does is they try to have a closed capital account, and they want to manage their exchange rate. But in effect, what that happens is, in effect, you hand over monetary policy decisions to, in this case, the Fed. And so as the Fed is raising interest rates, you obviously, in a world where China needs to lower interest rates to keep interest rates low, they're in this bind. And so ultimately, that's what Keith is alluding to when he talks about whether it's Japan. Japan has free mobility. They want to peg their interest rate low, and so you can see the exchange rate devalue significantly. China is a different economy. They don't want to have a free capital movement, but they want a pegged exchange rate, and therefore they lose the ability to control their monetary policy, their interest rate. And so it's called the policy trilemma, I think, or the impossible trinity. But basically, in effect, the reason it's called the impossible trinity is because countries, especially authoritarian countries, try their best to manage all three of these balls at the same time, and ultimately it ends in tears. Which is, I think, Keith, did I do a good job on that? I mean, maybe I screwed that up, but
What did you call it? The impossible what?
Trinity.
Geez, is that your opening line at the bar? Have you heard of the impossible Trinity?
Hi, I'm Richard Diaz.
Hey, have you ever heard of
Richard
the impossible
Diaz.
Trinity? I'll show you the impossible Trinity.
Jeez.
But I think that's a better line for you, Rich, than the other one, the financial
repression.
Oh man, you want to hear about the impossible Trinity? And the response would be, I know what it's going to be. It's like
The impossible Trinity does sound a little bit more curious.
That's true. Okay, I'll try that next time.
But maybe it should be the possible Trinity, because you want to go down that route. We'll get you lined up.
Positive. You want to be positive.
So in Vancouver, if you see Rich lined up at the bar, you're going to be in for a bit of a doozy conversation.
Let's say everybody pull out your Twitter account or your Tinder accounts.
Listen, you monkeys can make fun of me all you want. I'm right about this. That's what leads China into trouble. Yeah, go ahead. Sorry.
Rich is absolutely right, because one thing, if you have your currency pegged, it's to the US dollar, which means you do not have monetary policy control. So you cannot control the money supply or the level of interest rates. You're basically outsourcing that to the Fed. And that's why the Chinese, they had to cut interest rates suddenly there a few weeks back, because they did it to offset what the Americans were doing. And this is a problem all over the world. And so if you think about the story I was telling there earlier, with the Japanese and the Chinese, the next big market, so you have to look around the world. That's what we like to do. Okay, if this is happening in Japan, we know why, because they cannot tolerate rates going higher. They got to do QE, try to maintain it. Like nothing is working, and it has to work forever. So I look at that and I say, okay, wow, that's a great allocation to make. But then you say, who else around the world is in a similar position or unfortunate position? And that's where you get what I call the economic fantasy land called Europe. I think, I gave you my target for the
great example.
Euro. Yeah, I think Euro will go to zero. I mean, that's where that thing is going. That's dramatic, of course. But again, with Europe, they have the exact same setup now as the Chinese. And then the Europhiles out there, oh, that's not true. They got
it is true,
this and that. And
but it's true.
Like,
Greece is a perfect example. No, but Greece is a perfect example.
Absolutely dead. Yeah.
Sorry to interrupt you, Keith, but this is important. This is, I think, really important, right? So Greece is the perfect example of that, right? They have no control of their monetary policy, but you can only pick two of the three options. And that's what gets somewhere like Greece into really big trouble. And then you always have to devalue internally, which is what China is doing, which is destroying their consumption. Your real wages fall, you devalue internally, or you devalue, and that's what Greece did, right? In order to mitigate all that debt burden, or you devalue externally, which is what's going on. And in effect, you tank your currency, which is what's happening in Japan. And anyway, sorry, carry on.
Yeah. So what people don't realize with the Eurozone, so it's 19 countries that are in it. So it's every country that's in Europe except for Switzerland and a few others, which I can make lots of fun about Europe. However, when all these countries decided to join the euro, a really interesting thing happened, is that the Germans, basically their currency, the Deutschmark, went from around 180 down to 1. Okay, let's just round the numbers. So they went from 2 to 1. So all of a sudden their currency got cheapened by 50%. And what does Germany do the most with their economy? They sell stuff to everyone. So it just is such a boon for those guys. Meanwhile, the Italians and the Greeks and the Portuguese and the Spanish, their currencies effectively doubled in value. So it became even more difficult for those guys to do stuff. So it was a great deal for Germany, but a really bad. This is from a financial perspective, mind you, but a really bad deal, for Southern Europe. And here we are now, like 25 years later, I guess, into it. And which is very young for a major currency, by the way. And there's just cracks and chinks in this armor all over the place. And so it sort of reminds me, one of you guys mentioned the IMF storyline this week. Tell us about that, Steve.
Yeah, head of the IMF. So if you don't know the IMF, it's the International Monetary Fund. It's basically the central bank of central banks. And so she did an interview, TV interview with Jay Powell and Lagarde there of the ECB. And she basically came out and said that sovereign defaults were likely this year. Of course, she's more so referencing emerging markets, but she said sovereign defaults were likely this year and that we basically had to get out. And the sooner that we were able to basically restructure the debt of some of these countries, the better. And so, yeah, she went on to basically talk about what we talk about in the show, and what Keith has really been banging his drum on, which is that, listen, the US dollar is probably going to strengthen, and that's going to make these debt burdens even more heavy for a lot of these countries, and that's going to suck capital out of those economies, and again, just create all sorts of stress. So pretty interesting to see really the head of the IMF coming out so publicly and saying that. Really, it was kind of off the cuff. So I don't know if you have any additional thoughts on that, Keith, but
No, I mean, I think you described it very well.
Well,
but one thing.
Oh, go ahead.
So one thing, I had a conversation yesterday with a guy about maybe the IMF stepping in to help countries. The IMF can work during a normal functioning global economy, and they can function when they need to help a very small country that needs help. Everything today has just become coordinated on a global basis, and we're all at 0% rates, and debt is, at extreme levels. The IMF is not capable of helping any of these major countries if they run into trouble. So again, it's just to share with you, the old school thinking. Yeah, the IMF can step in and help these guys out. They can't. It's not close to being an option.
Well, is that not when they just go running to the Fed?
Well, yeah, everyone will go to the Fed anyway. I mean, you'll ask for a swap line, and swap lines. If you should, for a bit of fun, maybe that's what you say at the bar, Rich.
Yeah, I was going to say.
Let's analyze some of the Fed swap lines.
Hey, baby, what are you doing tonight? You'll analyze some of those Fed swap lines.
Swaps. That's what they do at the Boomer Castle.
Yeah. Swap night at the Boomer Castle.
You should take a look at who has been approved to have a swap line with the Fed. And well, you'll notice it's all of the Americans' geopolitical allies. So you could have a financial crisis taking place somewhere in the world. And then you have to figure out, hey, is the Fed so will the Fed step in, give them a swap line and stuff like that? If it's one of their non-friends, it ain't going to happen. Like it's just not happening. So again, I just try to encourage people to think of the world differently than a nice, clean world that we live in. That people think
empires have been using their monetary policy to soft or hard power for as long as there have been empires, right? I mean, that's not particularly new. I mean, whether it's the Spanish Empire or the Portuguese or, the Zulu warriors. Everybody uses that financial muscle to get what they want.
Yeah, I've got a question. Is the EU actually attempting to embargo Russian energy here?
I thought Poland already sort of agreed to do that. It's not clear that they can at all. I've got a chart which I'm happy to share that Steve gratefully retweeted that just shows. EU produces no oil and they consume like 10 million barrels of oil a day. I can't exactly remember the number, but it's a lie. They cannot say no to Russian oil. It's not possible. They'd have to import every single drop of oil from the Middle East or the US. It's not tenable. I don't think it's a realistic thing to do.
It's funny. I tweeted out yesterday. I said, I'm pretty bad at memory what I put out there. Some of it is good. And then there's this one. Something I don't remember. Now Steve's going through my Twitter line. What did he say? It basically, if the EU, shuts off Russian oil altogether, who loses first, Germany or Russia? And the answer, of course, is Germany. So, because I saw one narrative is that, if the Europeans turn off the Russian oil, all the oil gets backed up, and Russia, they need money coming in, all that stuff. Yeah, that's true. However, the Western world would just roll over if the Europeans roll over. And people might be thinking, hey, the winter's over now. They don't need the stuff to heat their home. So they got about a 2-month grace period. Then when the summertime is going to come, and it gets freaking hot in Europe. It gets so hot during the summer. And so they need air conditioning on at that time. So, they have a bit of a reprieve now, maybe taking place, but it's coming.
Yeah, I mean, pretty interesting, obviously, that Russia's demanding payment for their energy in rubles. Kind of playing a little bit of chess there.
I think there's checkers.
Chess. Playing swap lines with the Fed. I don't know. I mean, what else we got going on here? We've got we talk about the carnage in the bond market year to date. Rich, is this correct? The bond market's lost, was it greater than 10% year to date now?
Yeah, it depends on what duration you're talking about. It depends on what kind of credit quality, et cetera. But more or less,
I was looking at the chart that Jim Bianco put out, which is the total return of the Bloomberg Global Aggregate Bond Index.
Yeah,
it's off to its worst start, I think, in history.
So I like I tend to do this. I mean, I usually do that one, or I do the Vanguard Global Bond ETF, which is just a way of sort of doing something that everyone can sort of track on Yahoo or whatever. And it's down 7.7% year to date in dollar terms. I mean, that is, by the way, an incredible collapse in what's supposed to be not risk-free, but you know what I mean? It's supposed to be a fixed income. It's supposed to be safer. I mean, you're getting sort of equity volatility. What is it? Return-free risk, I think someone coined. I wish I had thought of that, but it wasn't me. I can't remember who that came
Risk-free return, Rich.
No, I know, but the bonds give you return-free risk, right? That's the joke. Oh, right.
I get it.
Boomer missed out. I'm sorry, Keith. That was really cute.
Way too sharp for me. But Rich, why don't you share with us the returns of some of these Canadian companies that are close to the housing market?
Good, great transition. Because we are getting towards the end of the show. We have really rarely talked about Canada this show. So I apologize to our Canadian listeners, but as you guys know, as we talked about, it all ties in. So you got a lot of big dose of Japanese yen bombs in your audio there. But Rich. So one of the things that we've been talking about is the early cracks in Canadian housing. Of course, we opened up the show talking about people trying to walk away from deposits, and one of the best ways to look at that is really what's happening in the Canadian banks. So Rich, what's going on over there?
Well, so the banks are easy. Everybody sort of knows that, but I think if I may, we can just dig a tiny bit sort of below that level. So everybody knows the banks haven't been doing well, but banks globally haven't been doing so well. So there's other companies that I like to look at, and Keith actually is one who put me onto one of these, which is Home Capital Group. Now this was made famous by, I think Warren Buffett got an absolutely sweetheart deal to come in and buy an enormous chunk of it at Warren Buffett, he's a great investor, but he gets he's definitely on a lot of people's speed dial, which helps his return profile. But anyways, so Home Capital Group, which is a Canadian-based holding company. I'll just read here that they do basically lots of residential. Sorry?
Yeah, it's basically alt lending. So let's put it this way. If you are a non-prime borrower, so if you're like, oh, I'm going to go to RBC and get a mortgage. Well, sorry, you're like, you're self-employed, you don't have a great credit history, blah, 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 blah. Your next bet is you go to Home Capital Group. So it's like, it's a lot of self-employed. It's like,
right.
Anyways, it's less than stellar borrowers basically usually.
But so it's already down 17% year to date. And, they peaked at 44 and now it's at 31. So, that's, I don't know, I'm really bad at arithmetic. So it's like 30%, I guess. Another company that I look at, which is, it's called ZZZ. If you want to look at, trust me, this is not investment advice, but ZZZ is Sleep Country Canada Holdings. And so it's, this is sort of like a more esoteric kind of something. I like to look at indicators that are obviously very specific and very related, but I also like to look at sort of kind of second order indicators. So, you know, if you're buying a house, what would you need to do? You might buy a mattress. And so that's why I think Sleep Country is like a good sort of, you know, indicator to look at this. And again, you're down, you know, 33% year to date. Another company that I look at is, I mean, sorry, this is boring, but I think it's really one last one. And then I really want to say something about Stats Canada. Is the ticker is EQB, I think. EQB.
Equitable Bank.
Yeah, so it's the same thing. It's just one of these alt lenders, and again, you're down significantly. So, you know, we were at $80, you know, just like a few months ago, and now we're at, you know, 58, so another 25%, whatever. And it's another kind of it's a financial service business that helps provide either home equity lines of credit or single family homes and stuff like that. And so, you know, if only there was a way to sort of short all these companies that in one go, but yeah, so you can really see there's some cracks opening up definitely in this housing story for sure.
Another one is the Americans love this one is the Canadian Tire.
Yeah.
That one's also down. I don't know, 10% this year, but Canadian Tire is for those who aren't aware, it actually has a huge credit division. They issue.
Oh, I didn't know that.
Yeah, they actually issue a lot of credit cards. So a lot of deadbeat borrowers, apparently.
Vendor financing. That's what you call it, really.
Yeah.
What do they call it?
Well, I would call it vendor financing. That was the downfall
Vendor
of General Electric. I remember a few years back, they were over on the island doing one of they thought they had an easy road show, you know, to pitch the company. They go through all this stuff like, yeah, you know, we're AAA rated. And I'm looking, I said, you might think you're AAA rated, but as soon as your buyers stop financing stuff through you, you're screwed, which is what happens, which is sort of,
I mean, if you gotta, you know, finance your microwave, you might have a problem.
Or pizza.
Well, if you have to sell, if the people that are buying your product, the only way they can buy it is if you lend them money to buy it. You know,
wait a second. Wait. That's true of a lot of very, very robust businesses, like for example, Volkswagen Financial or whatever it's called most car companies make more, and people may not know this, but a lot of car companies make more money from financing the purchase of their own cars and the servicing of those cars than the actual sale of the car. So Volkswagen is a perfect example of this.
I mean, I get it if you've got to finance a house or a car, but I mean, if you're financing like your NutriBullet blender for $99, I mean, come on, man. If you can't rub together $100 for a new blender, like you probably shouldn't be buying it. But
the king of Kitsilano.
Yeah.
King of Kits.
You're elitist. You elitist.
Yeah,
how dare you?
Elitist comment that I can afford my own microwave.
I mean, I really like going to Value Village. There's a free plug for them. They have lots of used stuff that works really, really well. But can I do my piece on Stats Canada, please, before we wrap up?
Sure. We'll
okay,
wrap.
This won't take long.
I don't know.
This won't take long. So I've realized I listen to our podcast every week, and I think sometimes we're a bit too negative on the Bank of Canada and the government of Canada. And so I promised myself this week we would give a positive shout out to an organization in Canada that probably doesn't get any credit or recognition, but I think deserves, frankly, a really big pat on the back, which is Stats Canada. And I've been in the weeds of statistical data for the last 15 years. I love it. And I think Stats Canada has really upped its game. So congratulations, Stats Canada. They've redone and reorganized all their data. The revisions that they've done are excellent. They've lengthened sort of how far the data goes back. So all the data that I show, whether it's debt service ratios or debt to GDPs, which by the way keep climbing in Canada, or inflation that goes back to 1960s, real interest rates are way too low. You know, all that stuff comes from Stats Canada, and they've really, frankly, improved their offering, which is all free and all online. If only, you know, some of our financial ministers could go and dig it up themselves, maybe they can make better decisions. But in any event, they deserve some kudos. So
you should really be thanking Jagmeet Singh for approving the loan to fund the new budget at Stats Can.
No, they deserve, we make fun, but if you don't have data, even the government of Canada cannot read that data and then make terrible decisions with good data. I mean, you know what I mean? Garbage in, garbage out. And so I just want to give them props. They deserve it. So to all the people at Stats Canada listening, good for you. And thank you very much. Go ahead. There you go. That's my piece.
last little joke just to end it off. Pierre Poilievre announced today that he's going to try to put a ban on the Bank of Canada's central bank digital currency plans. So to add sort of to the conspiracy theories as we've chatted about on the show before, there you go. Take with it what you will. But we'll leave it there.
Did he announce that?
Yeah, he did this morning, I think.
Man,
he said he wants
wasn't a ban.
He's again suicided. He's yeah.
Love him or hate him. Yeah, I don't know. I mean, love him or hate him. He said he came out and was like, we want to audit the Bank of Canada and we want to put a stop to them and their central bank digital currency program because this is going to nationalize. It's going to give the Bank of Canada too many powers, basically.
He's right.
I mean,
he's right. Of course,
he's definitely not wrong. But of course, like, good luck explaining that to the average reader of CBC News. They're like, well, this guy's a crazy idiot. He likes Bitcoin. Bad man. Laser eyes. We'll leave it there. As always, guys, we appreciate the listener support. Come join us May 12th, the Loonie Hour event. Again, if you want tickets, there's going to be a link in the description below. Whatever platform that you're listening or watching to this show on, you could easily go and get your tickets. Like I said, we don't have a whole lot left, so hoping to get those sold out here in the next few days. And looking forward to seeing everyone May 12th. And we'll see you next week, regardless.